Hello, everyone, and welcome to the iStrategic weekly update for Friday, the 29th of May. I'm going to do something a little bit different today, and instead of talking to you, I'm going to actually share my screen, and we're going to look at some of the charts and some of the data that I've been referring to in some of the topics I've been writing about over the last couple of months. So you can see where I'm getting it from. So a couple of things we've talked about are the divergence in markets. We've talked about regionals versus capitals, the general undersupply in the country, and we've talked about rental escalations. So let's jump into it. The first one I'd like to point out is this is from Cotality's latest monthly housing report. This is an overview. Let's have a look at Australian housing values. Over the 12 months, we've had a total increase of 9.8%. Over the 3 months, 1.6. But look on the right, this is one that I want to illustrate. It helps illustrate one of the things I've been talking about is the divergence. This is the range in capital city annual growth rates, 24%. So Perth was the highest performing capital city, which rose 26%, and Melbourne only rose 2%. So there's an illustration right there as to picking different markets and the very vastly different outcomes that you achieve. Okay, so the next one, let's just take a look at Australian dwelling value changes over the last 12 months. On the left here, you can see some totals. So for Australia in total, it was 9.8. The combined capitals grew 9.1%, and the combined regionals grew 12%. If we look at the middle band here, the red band, what you can see is the regionals for each state and territory. Regional WA was the far out performer, followed by regional Queensland. Now, just below it, in the yellow, you have the capital cities and their growth rates. So Darwin surged 19.6%, Perth 26%, Brisbane 19.7%, and we can see Melbourne and Sydney here. They still grew, but very, very small growth. And over on the right here, we can see the combined regional markets grew 12%, and combined capitals 9.1. Again, that divergence between regional and capital is something that I've been talking about, and indeed it helps decide for some of my clients where we want to invest. Okay, this one is really interesting and illustrates some points very, very strongly. So this is Australian dwelling values, the capital cities by value segment. Now, what do we mean? If you look over here on the right, you see 3 different colors. Now, the orange represents the lowest 25% of values. The yellow represents the middle 50% of values, and the purple represents the highest 25%. So let's take a look over here at Sydney. You can see that the highest end of the market dropped 2.7% in 3 months. That's a pretty big decline. While the middle and the lower end of the markets did not decline, they actually were quite, they were steady but didn't grow much. Same sort of story in Melbourne. The largest declines are in the top end of the market. Now let's look at the high performing capitals. So like Brisbane, for example, the low end and the middle end really outperformed. The highest end of the market still grew, but not as much. Same sort of pattern in Adelaide, same sort of pattern in Perth, where the growth has been the highest. The lowest end of the market grew 8.3, the middle end of the market 7.3, and the high end of the market still grew, but a bit slower, 5.7. Keep in mind, this is a 3-month growth period. That's exceptional growth rates. But you can see the same pattern in all the cities. The highest end of values had the lowest in terms of total capital growth. And in the downturn markets of Sydney and Melbourne, they actually led the declines. So again, that's something that I focus on with my clients. We look to purchase in the middle or the lower end of the markets, depending on where we are. All right, let's move on now to rents. I've talked a lot about rents in the last couple of months. So we have a vacancy rate nationally of 1.7% at the moment, which is extremely tight. The decade average is 2.5 for some context. Now, over on the left here, this is the annual change in rental rates. So in Australia, rents grew by 5.7%. And you can see that the combined regionals grew slightly more at 5.9%. Now, keep in mind, CPI is currently 4.2%. So rents outperformed by over and above CPI in basically every market. Now, let's take a look at the middle blue here that you can see. These are the regional markets in each state and territory. Regional Tassie had the highest rental growth rates of 10.1%. Regional WA, 9%. and regional SA and Queensland were pretty strong as well. Now moving down to the darker green, this is the capital cities. So you can see Darwin had the strongest rental growth of 9.1%. Hobart and Perth were still pretty strong, Brisbane. But what's interesting to me is that Melbourne and Sydney still grew at above inflation, even though their capital growth rates were quite lackluster. So it tells you there's still rental demand in those markets. All right, what I want to talk about now is supply. Now this chart is taken from Hotspotting, from their dashboard. Now, what it is, it's a graph showing how ahead or below we are as a nation in hitting the housing accord targets. What is the National Housing Accord? Well, there's a target to build 1.2 million homes over a 5-year period. That's 60,000 dwellings per quarter. So how do we go? So this is dwelling completions, which I must say is different to DA approvals and commencements. They're also, both those categories are also below target, but I'm specifically just targeting dwelling completion. So this is properties that are actually finishing. So we take the ABS data for each quarter and we compare it against the 60,000 dwelling target. And you can see that right now the nation is 21% below target. So again, this is an undersupply story, and this one really illustrates how far we're falling short of just the housing accord target, which doesn't fix supply completely, but it was supposed to bring some relief. But even that, we're still quite far below it. All right, finally, I want to focus on this really great looking chart from Cotality. It's called the chart of the month. Now, this talks to the resilience of real estate in general. Let's have a look. Over the past 40 years, Australia's combined capital city housing market has navigated 10 downturns where home values fell over at least a 3-month period. The most significant decline was 2017 to 2019, where values fell by 8.2%. So let's reread that. Values fell. The most significant decline, values fell 8.2% during a period of credit tightening and following a period of solid growth. To me, that's really incredible, because I would have thought that perhaps the GFC in 07, 08, 09 would have been the strongest one, decline that is. But I looked at that period, and according to this data, over the GFC, real estate across the country fell 7.1% over an 11-month period. A couple of years later, it had another fall, 5.4%, obviously followed by years of really strong growth. But yeah, the strongest downturn was a total of 8.2% over a 19-month period from 17 to 19. Now, that's actually even better than the start of the COVID pandemic. Who remembers back to 2020, when most economists were saying that we could expect housing values to crash by 20 to 30%. I don't know if you remember that. I remember that clearly. They fell in a total 2.3% before massively rebounding, as we know. So I just want to finish on that because it's a point that one of the reasons I'm in real estate is because it kind of is slow moving, has good, strong fundamentals, and I guess we could say that the worst case scenario that we've ever seen over the last 40-year period is a decline of 8.2%. Now, that's pretty resilient. Now, I understand that that number would have some divergence in it as well. Some areas, suburbs and regions would have declined more, and some less. Some probably actually didn't decline at all. But the point is that overall, it's been a fairly stable investment class for Australians over many years. Well, look, that's it for me today. Thank you very much for listening, and I hope you have a great week. I hope that was insightful, and feel free to reach out to me if you'd like to know where I got that data from. I can send it to you, no problem. Thanks very much.